It's the 80s. Zoom in on a certain American city and you'll see dorky coders out-earning even the most alpha business chads. Where is this land of opportunity, you may ask? Silicon Valley. Tech startups were the bomb diggity, and Silicon Valley was the epicenter. Over a game of poker, a couple former Bank of America managers decided they were going to serve these garage coding Andes because banks like Citi weren't giving them the financial services they needed. Flash forward to today, and Silicon Valley Bank has 55 offices across the world. They specialize in working with startups and serve half of all companies in the US that have received venture capital investment. Side note, venture capital firms invest in new companies. SVB provides venture debt, meaning loans with terms that help founders succeed, like company equity as collateral instead of an asset like a building, and long-term due dates. SVB also connects founders with their network of investors, accountants, lawyers, and companies looking for new tech. Everybody makes money, win-win. Through COVID, the Fed's extremely low interest rates and trillions in relief from Daddy J. Powell juiced the US stock market harder than Dwayne Johnson. The private equity market saw a similar boom, with venture capital investment doubling in 2021. This meant SVB's clientele had a lot of new money. And where do they put this money? The bank. Deposits tripled in only 3 years, reaching nearly $200 billion by 2021. We all know how banks work. They take your money, give you a little interest, and then loan it out or invest it to get a return. Because of how fast SVB got this money, they weren't able to quickly and responsibly loan it out. So they invested nearly $100 billion, the majority of their cash, in US government and government-sponsored debt. Safe, right? With inflation soaring, the Fed started raising interest rates to curb spending, meaning J. Powell went from cash fire hydrant to dribbling pennies. Tech stocks took a tumble and venture capital became more frugal, decreasing new investment by 35% in 2022. This meant SVB's depositors were going to have to dig into their war chests to keep up and running. About $25 billion had drained from the bank by the end of 2022. Normally, this wouldn't be world-ending, but something else was happening at the same time. The bonds that they had invested the majority of their cash in earlier had tanked in value. Let me explain. A bond's price and return are directly connected. Let's say I bought a $100 bond from Apple, bond A, that pays me $10 every year, meaning 10% return. But Apple just announced they're issuing a new identical $100 bond, but instead it's paying $20 a year, meaning 20% return. Obviously, you would want a 20% return instead of 10%, so the value of bond A drops. As the price drops, the $10 stays the same. So, after the prices equalize, you can either buy bond A for $50 and get $10 every year, a 20% return, or you can buy bond B for $100 and get $20 every year, a 20% return. What this means for me is that my bond, bond A, just lost half its market value. And this is what happened to SVB. They bought a bunch of debt that paid on average 1.6%, but now, because the Fed had increased rates, that same debt was paying 5% in the market. While this may seem small, it meant SVB's bonds had lost $16 billion in market value. And even this wouldn't be the end of the world if they could just hold the bonds until maturity, meaning until the bonds had made all of their scheduled interest payments. They would have earned 1.6% per year, and that $16 billion loss in market value would just disappear. The only problem? The bonds wouldn't mature for 10 years. So, SVB's stuck. Their only customer base, startups, is pulling out their money faster than J. Powell can say quantitative tightening. And the only way to fund those deposits is by biting a multi-billion-dollar bullet. At this point, they had gone through every pipe in the house, out through the faucet, and were now circling the drain. On Wednesday, March 8th, SVB announced that they had sold $21 billion in securities at a whopping $1.8 billion loss. On top of that, they announced they were trying to get $2.25 billion from equity investors to make sure that they had enough to cover withdrawals. General Atlantic had even pledged $500 million to the cause. The public reacted completely rationally. They understood that the bank had enough funds to cover withdrawals as long as no one went crazy. No. Everybody lost their minds. Reminiscent of the great COVID toilet paper bonanza, middle-aged men in Patagonia jackets were stomping on their comrades to get to the teller. On March 9th, in a single day, $42 billion, a third of total deposits, was pulled from the bank. The stock market wasn't happy either, with nearly $10 billion in value, 2/3 of what the company was worth, wiped out. At day's end, there was nary a paperclip in SVB's vault, and they owed a cool $1 billion to the Federal Reserve in what was supposed to be an overnight loan. They couldn't pay it. On March 10th, the following day, the Federal Deposit Insurance Corporation announced that they had kicked out management and were taking control of the bank. The FDIC is there to make sure that people's deposits are safe, and they actually insure up to $250,000 for each type of account at each and every bank a depositor has put their cash. Usually, 1/3 of deposits at a given bank are insured by the FDIC, but because SVB's clientele is startups who have millions of dollars in even a single account, only 5% of deposits were insured. Once the FDIC took control, the New York Stock Exchange had also paused trading on the bank's stock. On the 12th, the FDIC announced they were going to insure 100% of deposits at the bank, way more than the 5% legally required, fully paid for by a special fee to US banks. While out of the ordinary, this decision reassured the public that deposits were safe, encouraging them to keep cash in their accounts and, in effect, discouraging further bank runs. You may be wondering why no one was keeping an eye on the goings-on at SVB. Banks the size of SVB would have had annual stress tests by the Federal Reserve to make sure that they had enough cash and assets on hand to avoid a situation exactly like this. However, in 2018, because banks was sad because there were so many rules, Trump loosened regulations and made these requirements only necessary for bigger banks. Since the collapse, the public has gotten a heaping helping of fear-mongering, partially warranted considering both Signature and Silvergate Bank failed in the same week. However, they're not really that connected with SVB. These two had taken a walk down the dark alley of crypto and got mugged, kicked in the face, and had their mothers insulted. The unrelated cause, along with the announcement that all of SVB's deposits would be secured, has quelled fears for now. While bank collapses in the past have spread a contagion, bankrupting other financial institutions, it seems like the SVB STD won't be spreading.
Yeah, I might have to take that one back.
Thanks for watching. Check out this video if you liked it, or maybe this one.